The math suggests a controlled input of $388,853 can generate two simultaneous returns, an insulated liquid asset approaching $1 million and over $6 million in real estate yields. This 30-year model requires routine annual deposits. How does that finite input support both sides? The first output is a secure, highly liquid capital reserve. This is money that remains insulated from market volatility and continues to compound. The second output is a much larger yield generated entirely outside of that reserve, actively deployed in the short-term real estate market. Traditional financial mechanics dictate that a single dollar cannot be in two places at once. Capital deployed into a volatile asset cannot simultaneously remain insulated in a compounding reserve. To understand how this works, we have to look at the underlying architecture. The proposed architecture to solve this is known as the infinite banking concept, or IBC. IBC is a strategy that uses a custom-engineered, dividend-paying whole life insurance policy as a private capital reserve system. A custom-engineered, participating whole life insurance policy functions as a foundational capital warehouse, a balance sheet designed to store liquidity without exposure to market risk. Operating this warehouse relies on two specific mechanical phases: non-direct loan recognition and interest rate arbitrage. Validating this strategy requires proving the math behind those mechanics. We have to map exactly how capital is mathematically buffered from macroeconomic shocks, while concurrently deployed for high-yield returns. We start the mathematical model with $110,000 initial capital injection directly into the warehouse. This graph illustrates the immediate capitalization friction. In the first year, your available liquidity dips to roughly 94% of your input. You put in $110,000 and you have immediate access to about $103,000. This initial drop creates what is known as a J-curve. A J-curve is a trend line showing an initial loss or flat line, followed by a dramatic gain. Here, the dip represents the required infrastructure costs to legally secure the $1.5 million death benefit collateral. As the timeline advances to year 10, the curve crosses back to 100% efficiency. At this point, the cash-on-cash return doubles, and the warehouse begins exponential, uninterrupted compounding. The capital within the warehouse grows completely independent of the stock market. It relies on a combination of guaranteed interest and annual dividend payouts from the insurance carrier. Because of the specific contract structure, this internal growth continues undisturbed even when you utilize the capital outside of the warehouse. Navigating the first 3 years requires systemic discipline. The policy is designed to act as a heavy-duty, long-term balance sheet, not a high-yield liquid checking account. The core engine driving this strategy is a mechanism called non-direct recognition. This feature ensures the insurance company does not decrease your dividend or interest rate when you have an outstanding loan against your cash value. Here is exactly how the capital moves. The investor never actually withdraws their own funds. Instead, a secondary block of deployable capital is generated outside the warehouse. The investor borrows against their cash value using the death benefit as collateral. This loan carries a fixed friction, like a 7% annualized cost. This borrowed capital represents up to 90% of the available liquidity. It is completely liquid and ready for deployment.
Because the original funds were never withdrawn, the baseline capital remains fully intact inside the policy. That intact capital continues to earn compounding interest and dividends on the total gross amount, as if it never left. This non-direct loan structure allows a single block of capital to exist simultaneously as a secure, compounding asset and as deployable leverage. We now track the deployment of that 90% borrowed capital. It moves out of the general fund and into a short-term, high-yield real estate vehicle. The formula that makes this profitable is straightforward. We take our gross investment return from the real estate deal minus our 7% control cost to find the net arbitrage profit. That 7% control cost is the fixed annualized friction of carrying the borrowed capital from the insurance carrier. Capturing a higher short-term yield in the real estate market deliberately offsets this carrying cost and isolates the positive spread.
The initial loan is paid back, and the remaining net arbitrage profit is cycled back to top up the warehouse. Putting this specific deployment cycle on repeat mathematically compounds the real estate returns directly on top of the warehouse's internal baseline growth. The resulting multi-million-dollar secondary yield is simply intentional arbitrage, capturing the spread between a controlled cost of debt and a higher-yielding asset over several decades. This chart shows the macroeconomic impact of the system when operated continuously over a 30-year life cycle. To keep the warehouse funded after the initial injection, the strategy requires depositing exactly $10,000 every year. However, at year 11, that annual injection drops to $8,993 to comply with federal limits. This threshold is the MEC constraint. A modified endowment contract is an IRS boundary dictating how much cash can be contributed to a policy before losing its tax-advantaged growth status. Staying under the limit preserves tax-free access. When limits are respected and arbitrage continually reinvested, the timeline completes its 30-year run. Internal cash value hits nearly $1 million, while real estate yield surges to $6.2 million. Those two figures stand in stark contrast to the total out-of-pocket input over that same period, which was just $388,853. That combined return of over $7 million is a product of compounding math, assuming strict adherence to both regulatory limits and mechanical discipline. The math holds up, but it faces one significant external threat: sudden macroeconomic volatility. Fundamentally sound real estate assets rarely fail because they are bad investments. They fail because of forced timing. When rate spikes hit or refinance freezes occur, traditional, highly leveraged portfolios crack under the pressure of forced liquidation. The IBC model changes the physics of that pressure. The warehouse acts as a structural firewall against forced liquidation. Because the investor controls the loan repayment terms internally, the baseline capital is insulated from external margin calls or banking rate spikes. The investor maintains absolute liquidity within the warehouse. That liquidity provides the buffer necessary to survive market contractions that routinely bankrupt traditional operators. The ultimate value of this architecture is the systemic elimination of timing risks. Macroeconomic volatility is weathered rather than weaponized against the investor's capital.